Well, it wasn't a mere 10 days ago where people were calling for emergency rate cuts and a Great Depression, the likes that we haven't seen since the 1930s. It's just funny how quickly things can change. I honestly don't know of a single other community outside of ours that didn't choose to join the fear-mongering echo chamber of August 5th. And so far, that's been a really good call. I went as far as calling the stock market crash a fraudulent stock market crash, and so far, so good. Today, the Nasdaq's up 2.5%. My small caps are up more than 3%. Over the past 5 days, the Nasdaq's up more than 6%. And since the bottom on August 7th, the Nasdaq's up essentially 9%. So we're going to talk in today's video about the recent economic data. We have been crushing it. We have been crushing it in the stock market, doing research that other people just simply aren't willing to do. And that's paid off big time. You can even go back to like 2022 and find videos of this Goldilocks scenario that I was laying out that nobody else really thought was possible. And I know I'm running the risk of sounding cocky here, and that's not my intention at all. I just want to prove the point to you that what's happening today was not supposed to happen. Where we have a strong economy, where inflation continues to cool off and soften and reach the Fed's target. This wasn't even in the range of outcomes for most investors in 2022. But we've been willing to do this research and the extra work. And as a result of that, I don't do this often, but if you've been following along on this YouTube channel, please hit the like button for me. Let me know down in the comment section how long you've been watching. And on the way down to the comment section, if you're not subscribed yet, you might as well hit the subscribe button for me. It helps my channel out tremendously. But let's really talk about this. We're going to talk about the economic data, as I mentioned, and then we're going to talk about what I believe is going to be the next calling card of the bears and the hard landers, and it has to do with the yield curve inversion. So this should be a really fun video. First, let's talk about the volatility index, fun, VIX, as most of you will know it as, VIX. On August 5th, the VIX skyrocketed to over $60 per share. Today, it's cratered back to the $15 range. And this was one of those things we were pointing to that was really indicating to us that the fears in the stock market were much more technically driven than fundamentally driven, and that investors and big money really weren't concerned about recession or depression. We looked at the volatility index compared to the high yield corporate bond spread. Usually you can see on this chart, they are very, very highly correlated, but recently right here, they were not highly correlated. The VIX absolutely skyrocketed, as I mentioned, but the high yield corporate bond spread remained relatively flat. The reason this is a big deal is because if the markets are worried about potential recession or depression, the high yield corporate bond spread actually expands and widens because investors start to demand higher yield or a higher interest rate on the debt or the corporate debt that they hold if the risk of bankruptcies is going up or is about to go up. And that happens during recessions and depressions. This is what told us that, okay, the volatility index spiking to 60, while normally that would indicate something breaking in the economy, this time is different. I believed, and I think it's kind of played itself out here, that this was just a big short squeeze, where we've had investors for years that have been short selling volatility in the stock market and going long the stock market or equities. It's basically its own carry trade, and all of a sudden, in the snap of a fingers, all of that short leverage got wiped out. Very, very similar to the Japanese yen carry trade, where all of that short leverage got wiped out. This happened in the blink of an eye, and now it's just back to regular scheduled programming. But let's talk about economic data. I'd be remiss not to talk about inflation data first and foremost. We got an update this week on CPI and PPI. Both of these reports came in below expectations. So inflation is cooling off even more than people thought it would. This is the first time since 2021, in the beginning of 2021 at that, where headline CPI data came in with a 2 handle. Year over year, headline CPI only came in at 2.9%. You can see based on this chart, whether you're looking at headline or core CPI, we are well on our way to the Fed's 2.0% inflation target. And if we strip out shelter, we're already below the Fed's 2.0% inflation target. We've been putting this out for a long time that shelter is really the only thing holding up inflation when it comes to year-over-year comparisons. And that's because it's a different data series. It works differently than most other items in the economy, where you don't generally sign a new lease every month. You sign a new lease every 12 months if you're renting. And because of that, the increase in prices and the increase in rent take 12 months to show up in the data rather than being immediately evident in the data. So that's a big dichotomy that we've been paying attention to. And again, if you strip out shelter, which is definitely on the glide path lower, inflation data is already at and below the Fed's 2.0% target. When it comes to the economy, this morning we got another update on initial and continuing unemployment claims. This is a prime example of where we did the research that nobody else wanted to do. We said that the recent rise in unemployment claims came basically directly as a result of weather-related events, specifically Hurricane Beryl making landfall in Texas. During the month of July, we assigned a lot of the labor market weakness to that, and it looks like we've been correct. A lot of those workers are returning to work. Initial and continuing unemployment claims have fallen over the last two reports. So this is looking really good. And again, it's contributing to this Goldilocks scenario where the labor market remains strong, the economy remains strong, company earnings remain strong, and inflation falls. And this morning, we also got a new update to retail sales in the month of July. They grew 1.0% month over month. This was much above expectations and even above my expectations. And I'm pretty bullish on the economy. I figured as a result of less worked hours in the month of July because of those weather-related events, that retail sales numbers would be down during the month. Generally, if consumers work less, they're going to spend less. It's a pretty easy concept to understand. But retail sales came in really strong, indicating, a really strong consumer. This was not supposed to happen. This was not supposed to happen. As a result of inflation cooling off more than expected and the economy being stronger than expected, the odds of a 50 basis point rate cut in the month of September have decreased dramatically to basically 25%. These were at 50-50 odds not long ago, where there was a 50% chance for a 25 basis point rate cut and a 50% chance for a 50 basis point rate cut. This is down to 25% for a 50 basis point rate cut. I personally believe, if you followed my channel, that we don't need rate cuts at all. I'm kind of weird. The people that are calling for rate cuts right now are bulls that think we need rate cuts in order for the bull market to continue. That's their bias. I'm pretty unique in that I am bullish, but I also say we don't need rate cuts. I just think I'm more of a realist. I try not to make my bullish nature give me unneeded bias about this sort of stuff. And the reason I say that again is because the economy has performed great, company earnings have performed great, the labor market is really strong, and inflation continues to cool off and head towards the Fed's target of 2.0%. And as a result of these things, I believe the Fed is going to be one and done, meaning I think their only rate cut will be in September, and they won't cut rates for the rest of the year. I don't think we need it with the way our economy is performing. The last thing that the Fed wants is to reignite inflation, which happens when demand increases and supply slows down. And that happens when you loosen financial conditions or ease interest rates. We don't want a resurgence of inflation. And it's just the fact of the matter that recession indicators right now, they're incorrect. There's nothing out there that signals we are entering a recession or we're already in a recession and that the Fed needs to ease in order to stimulate the economy right now to prevent this from becoming a depression. There's nothing in the data that shows that. Prove me otherwise. Prove me otherwise. And then there's also the fact that through the years, our economy has become way less interest rate sensitive. Back in the 1950s, 2/3 of our economy, so 2/3 of consumption, investment, production, it came from the goods sector of our economy. The goods sector of our economy is way more dependent on debt to grow, to consume, to produce than the services sector, which only made up basically 1/3 of our economy in the 1950s. Those two things have flipped, where services now make up 2/3 of our economy and goods make up 1/3 of our economy. And for the most part, the 1/3 of our economy that is goods, we import most of our goods these days, where we're literally importing deflation from China into our economy. Services companies, they are much higher margin. They take less capital to start up. They have better balance sheets as a whole. And to grow, they need less dollars, which again paints the picture of this big shift that's taken place, making our economy way less interest rate sensitive. That could be part of the reason our economy and labor market has been very, very strong despite interest rates going up to 5%. Now, the reason this Goldilocks scenario wasn't supposed to happen is because most people out there believe in what are called long and variable lags of higher interest rates. I personally don't believe in long and variable lags of higher interest rates. Instead, what I believe in is a cycle. And I'll give credit to Yardeni Research. They're the ones that coined this phrase, the credit crisis cycle that can happen when interest rates are going up or monetary policy is tightening. And this plays directly into what I'm predicting the next talking point will be from the bears and the hardlanders. They're going to go back to the yield curve and say, oh, the yield curve is disinverting, which the yield curve will disinvert when the Fed cuts rates in September. That's basically a fact at this point. You know, the argument at first, it's kind of funny, was, oh, the yield curve just inverted. This was back in 2022. We're going to see a recession. Every time the yield curve inverts, we see a recession. Well, 24 to 30 months later, we're still waiting for this recession. And I don't hear anything coming along the train tracks. And I've started to see it already. The bears and the hardlanders, they're getting much more granular. They're saying, well, if you really look at the charts, the recessions don't come until after the yield curve disinverts or goes back positive or pops back higher. And while that is true, you can see that here. The recessions are the gray bars. You know, yield curve disinverts, recession. Yield curve disinverts, recession. Yield curve disinverts, recession. This is a fair point. I believe they're going to be wrong again. Let me explain this to you. Instead of long and variable lags tampering demand and ending up causing a recession, I believe in this four-step cycle where the Fed starts to tighten monetary policy. They usually do so until something breaks in the system and we have a financial crisis that's triggered. That is step number 2. This is when unemployment bottoms. Fun fact, we did have a financial crisis get triggered in March of 2023. A lot of you will remember Silicon Valley Bank, okay? And if we look at, I think I have a chart of this here, the mini banking crisis. It's true. Again, unemployment bottomed when this financial crisis event was triggered. Let's go back to my 4-stage outline here. I hope you guys appreciate my artwork. Step number 3, stage number 3 is a credit crunch, where the financial crisis turns into a credit crunch, and the credit crunch prevents even good borrowers from being able to borrow money and spend that money in the economy. Credit literally dries up, nobody's able to borrow, and the economy feels pain as a result of that, and that's when we enter a recession, and unemployment absolutely skyrockets. You can see this happen, tech wreck of the early 2000s, boom, unemployment soars. Bear Stearns, so this is the great financial crisis of 2008, 2009. Boom, unemployment soars as the recession takes place. This has happened numerous times in history. Okay, the important thing to realize, though, is based on these 4 stages, there's tightening of monetary policy, which can turn into a financial crisis that gets triggered, which can turn into a credit crunch, which can turn into a recession. Along the way, as a result of what the Federal Reserve has learned because of the great financial crisis and the great virus crisis, they can stop this cycle from continuing at step 2 or at step 3. They did this. They saw the financial crisis get triggered, Silicon Valley Bank fail along with some other regional banks. And what did they do? They announced this bank term funding program. Okay, and you can see that. It's the red line here on the chart. You can see how this absolutely soared in March of 2023. It's continued to soar, and most recently it started to fall back down. The Federal Reserve provided liquidity to the system when it needed it, which I believe has prevented the financial crisis from turning into a credit crunch. So while other people will tell you that the yield curve predicts recessions, I simply believe that it predicts or anticipates something eventually breaking in the financial system. And if that happens, it's still no guarantee that we end up seeing a recession if the Federal Reserve can successfully contain that financial crisis and prevent it from becoming an economy-wide credit crunch and thus an economy-wide recession. So when the Fed is raising interest rates, I ask myself, how long will it take until interest rates get high enough that it causes something to break in the financial system? I don't ask myself, as the Federal Reserve is raising interest rates, how long will it take until those long and variable lags cause a recession? I think this is a very important distinction. And I think a lot of economists, I think a lot of pundits, I think a lot of influencers completely dismiss this, that almost every single time that we have had a financial crisis in the past, yes, it has turned into a credit crunch. And what has caused the yield curve to disinvert in the past is the Federal Reserve having to cut rates in the snap of a fingers. And at that point, they're too late. This is what makes the yield curve snap back higher, snap back into positive territory. But this time, that's not happening. We don't have a financial crisis. We don't have a credit crunch. We don't have a recession. The Federal Reserve is not going to be forced to decrease interest rates because something has broken in the financial system. That is a very important distinction. So we're at a point now where the Federal Reserve is going to cut interest rates without a credit crunch, without a recession, and without a bear market happening in the stock market. This really hasn't ever happened in the past. And again, I chalk it up to economic shifts that have taken place, but also the Federal Reserve simply learning how to play whack-a-mole. Whenever they see a financial crisis happen, like Silicon Valley Bank, they've learned how to throw money at the system. And again, they can throw money at the system without having to cut interest rates. That's what they did with the Bank Term Funding Program. So the Fed has responded quickly and successfully to the banking crisis, which is the financial crisis we experienced, and inflation has moderated without a recession. This is the first time in modern history that this has been accomplished. And even so, if you're still not convinced of this four-step cycle, we can look at what causes a credit crunch. And it's the financial crisis, and it's when even good borrowers can't borrow money to spend in the economy. We can look at something like the Senior Loan Officer Opinion Survey, more commonly referred to as the SLOOS. And based on the most recent SLOOS, most loan officers are loosening lending standards. They finished tightening lending standards a long time ago, in March of 2023. When that financial crisis took place. Ever since then, less and less loan officers have responded that they are tightening lending standards, and all of a sudden, more and more loan officers are starting to loosen lending standards. Nothing in this screams that we're in a recession or we're about to enter a recession. Nothing about this. So I believe for the first time ever, maybe, the Federal Reserve, as a result of the great virus crisis and the great financial crisis, they've learned how to throw money at the system, as I already mentioned. Play whack-a-mole with these financial crisis events. They've stemmed the tide at step number 2. They've prevented the credit crunch, which prevents the recession. I don't believe in long and variable lags causing recessions. I believe in credit crunches causing recessions. And I don't see anything in the system that indicates we are about to trigger a financial crisis or that we're about to trigger a credit crunch and thus a recession. I just don't see it. And about the unemployment, a lot of you will say, well, if unemployment's about to skyrocket, then that's going to cause the recession. We've already dispelled this in previous videos. The reason the unemployment rate is rising is because of new entrants or re-entrants into the labor force. We can find this data. I've shown it on the screen in previous videos. You can go watch my most recent videos and see it. The reason the unemployment rate is rising is not because people with jobs are losing their jobs, for the most part. It's because of immigration, illegal immigration, people re-entering the workforce. It's causing the overall labor market to grow, which means less people have jobs, right? It means less people as a whole have jobs if more people are entering the workforce. That's why the unemployment rate is rising. This time is different. I know those are often referred to as dangerous words in the stock market, but I've been saying them since 2022, and so far this time has been different. I know this video was a little bit quicker than usual, but I just wanted to cover the yield curve in particular in one simple video and focus all of my energy and attention into it because I can guarantee you This is going to be the bears' next big point. They're going to point to the yield curve disinverting, and because the yield curve is disinverting, they're going to say we're about to enter a recession. I would encourage you to share this video with people. I would encourage you to bookmark this video so you can come back to it when those fear mongers come back and they re-enter that echo chamber. But for now, it's very simple. And I've been saying this for a long time. The economy is healthy. The Federal Reserve has room to cut rates by 5% if anything recessionary does actually pop up. And ultimately, the labor market, very healthy, and inflation is cooling. There's nothing out there to be concerned about or worried about. Worst case scenario, I like to say, okay, well, if we get a stock market correction, you get a chance to buy more companies at an even cheaper valuation. The biggest mistake you can make is selling all of your stocks and then you're sitting on the sidelines. Oh, I got this wrong. Why did I listen to this person on the internet telling me to sell all my stocks? That's the biggest mistake you can make. You know, the risk of missing out on the upside is much greater than the risk of missing out on the downside, I guess you could say. Because at least if you stay invested and downside does happen, you can always buy more, increase your holdings, increase your exposure to the companies you love. Whereas if the stock market continues to climb higher and higher and higher, you're forced to eventually buy back in at even higher valuations. And that tends to be when the markets peak, quite honestly, when everybody is convinced that the bull market is here to stay. And you know, so that's why all the skeptics, all of the quick, flips to the bearish camp, they actually encourage me about this bull market. I think the bull market's still very young because, there are way too many fake bulls that convert to the bearish camp at one piece of bad news, and they fail to do additional research. And that's where alpha is presented in the stock market. And again, if you want that alpha, I have a 100% refund policy to my monthly membership, and it means a lot to me. Just the fact you're watching this video means a lot to me. But if you want to go a step further, I'm entirely independent, entirely self-funded. Please consider joining my membership. We have a lot of fun in the Discord server. I think we just hit our 250th member, which is crazy. So thank you so much for that. But again, if you don't get alpha from the stock market via my membership, I have a 100% refund policy, and I have yet to have to refund anybody. Hopefully the content I put out publicly on the YouTube channel kind of speaks for itself, the sort of content I provide and the value I provide. But yeah, if you're new here, returning, not yet subscribed, please subscribe down below. Hit the like button for me. It helps my channel out tremendously. With that, have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.